Right. The stock market in Pakistan, the benchmark KSE 100 index year to date, and we're nearly, at the halfway mark for the year. We're up about 15%, and that's a continuation of a 57% return that the index generated in calendar year 2023. So that bull run that we saw last year, that's continued into this year. And the reasons are simply that we have the single-minded focus on the economy, which is showing through. We've had a difficult time last year, but a lot of the steps that the caretaker government initially and then the government now have taken, those are bearing fruit. Inflation was rampant last year. It is now. It seems like it's coming back under control. And from a peak of 35% in May last year, we are now talking about inflation heading down into the early teens. Even in the last number, that was about 17%, which is still high. It's nearly twice the long-term average in Pakistan. But the expectation is that it will swiftly come down in the following months. And what that means is naturally that interest rates, which are at all-time highs in Pakistan, will begin to come down. In the last seven monetary policies, the central bank has been prudent and has kept interest rates unchanged. But there is growing consensus and growing belief that the next monetary policy, which is due on the 10th of June, will see interest rates finally begin to come down. And if I were to basically distill how the stock market works in one sort of adage, it is that when interest rates are coming down, the stock markets are performing, and vice versa. And this is a global phenomenon. So naturally, and the other thing is that the stock market works in advance. It works on expectations. So it won't wait for interest rates to come down. It will work on the anticipation that interest rates will come down. So what we're seeing in the stock market is anticipation that interest rates will come down, which is really a reflection of the economic consolidation that is in place and the improvement that's come in, and that's reflected also in the stable currency as well. So I think two major factors are in play that are increasingly drawing investors to this market, which doesn't just include local investors but foreign investors as well. I mean, year to date, the foreign investment in Pakistan from the foreign corporates and the foreign institutions has been about $60 million. So January till date of 2024, that's the net amount of buying that we've seen. I think it can continue. I mean, obviously, prospects for Pakistan are looking better. So there are two factors in place. I mean, obviously, how Pakistan's economy and politics is doing as we speak, and of course, tailwinds are rising globally. So globally, also, it was a high inflation, high interest rate environment in the last several years, and that naturally is detrimental to the performance of riskier asset classes such as equity. So it wasn't just Pakistan's economy that was in crisis mode. It wasn't just Pakistan's stock market that wasn't performing. A lot of other, emerging and frontier markets witnessed the same level of stress, whether it's Egypt, Argentina, you name it. I mean, they've all been under stress. So I think we will see certain tailwinds arising from the reduction in global inflation and the reduction in global interest rates. So that's always good for equities as an asset class. And that's obviously something that foreign investors look at. But then you also need to add to that the improvement that we're seeing, the fact that inflation in Pakistan is expected to come down. And one other area that's historically been a pain point for foreign investors in markets such as ours has been the currency. Naturally, that is something that hurts them a lot if there is rapid depreciation of the rupee versus the US dollar. And there seems to be a great degree of comfort as far as the currency's outlook is concerned. Reserves are building up. We are initiating talks with the IMF in a very timely manner. The current account is under control. If anything, we've seen several months of current account surpluses. So something that has historically been a pain point for Pakistan doesn't seem to be a concern right now. I think foreign investment can continue. Data suggests that foreign ownership of Pakistani stocks right now is in the 4.5% to 5% range of the total market capitalization of this market. And if you go back in 2017, and I picked 2017 because that was the last time that Pakistan's stock market was, at the time, it was the peak, 53,000 points. At the time, the foreign ownership was about 10% of the stocks that were listed in Pakistan. So, if you anchor yourself against that number, we're still about halfway to where we can potentially be in terms of foreign investment in Pakistan. You're right, we have to maintain that balance. It's still a fragile recovery. Of course, reserves have grown, and they've now grown to about $9 billion with the central bank. But the import cover is still, roughly 2 months, slightly short of it, which is obviously, there is room for improvement on that front. And you're absolutely right that, we can't afford to slip up on that single-minded focus on stabilizing the economy and going towards improvement. But at the same time, I mean, even the IMF's, staff level report, which was released over the weekend, they talked about a data-dependent, data-driven monetary policy. And certainly, if the ultimate goal of the monetary policy is to bring inflation under control, it seems to be working, and therefore it is opening up a little bit of wiggle room for the central bank to reduce interest rates. I mean, let's not forget that GDP growth is still soft at about 2%. It's roughly half of Pakistan's long-term average. A lot of this growth is also being driven by the agriculture sector, not by manufacturing or by services. So really, if you want to balance that equation between inflation and growth, I would argue that the state bank's prudence so far has worked out, but certainly there is now a room appearing for the central bank to start bringing interest rates down. And let's not forget that historically speaking, and I say this because I know that we have initiated talks with the IMF. Historically speaking, whenever we have initiated these talks with the IMF, forget the program itself. In terms of, the IMF has usually called for interest rate adjustments, exchange rate adjustments as preconditions. But this is, at this point in time, we're at a very different point in the cycle. Unlike the past times when we were, approaching the IMF, the currency adjustment has already taken place. In the last 2 years or so, we've depreciated by more than 40% versus the dollar. Similarly, interest rates in Pakistan are already at all-time highs. So we're at very different times in the cycle, which is why you're seeing that the IMF is not necessarily asking for these sort of adjustments. It's gone straight into asking for tax reforms and energy reforms, and probably going to push through privatization. So it's a different part of the cycle. And so I think point taken on the fact that Pakistan needs to remain prudent, but I think there is still that room to bring interest rates down, and by extension, what that means for the stock market is more and more people turning towards this asset class compared to fixed income or currencies or other asset classes that have attracted investor interest in the recent past.